Got it. All right. So y'all can see the full screen, right? The chat isn't showing up on your end. Okay. So let's let's talk about what today is. Today is understanding human and trader psychology and real strategies we can use to implement this psychology. So a lot of people talk about psychology, but they don't really give strategies. And I wanted to actually get into something that I use every day when I trade. So let's get into it. So why do most traders fail, right? And most traders don't fail because of technical analysis or they're using the wrong chart pattern or they can't read the market correctly. That can easily be learned within 6 months' time. You know, you learn support resistance. Once you can read candlesticks and volume, support resistance, you basically know everything you need to know in terms of basic technical analysis. Obviously, there's more advanced strategies like reading the options flow, the way Hassan uses the tape. Those are more advanced strategies. But I do believe technical analysis isn't the hard part of trading. So we fail as traders because of our own psychology, but that's also the same reason the market works. So in theory, the market should be working perfectly if there was no human emotion. But when you add in fear, greed, and things like that, the market becomes irrational and you get short squeezes and you get huge sell-offs, right? When COVID hits, most people know the market's going to end up okay, but it's the fear that drops the market like that. Humans are irrational creatures, and therefore the markets will also act irrationally because humans are the ones behind the markets. So if you're not profitable, it's because you're lacking two things, a strategy and you haven't managed your emotions. So this quote by Tom Huggard, which is he's a great trader. He has an amazing book as well. It's people don't fail because they don't know enough technical analysis, because they don't understand what the markets are doing to themselves. So I want to get into what the markets are actually doing to you, and I'm going to start listing a few behaviors that humans are naturally wired to have, and the only way to be successful in the markets is to get rid of these behaviors, right? So, okay, I'm actually gonna do it like this. All right. So let's talk about understanding humans. There are natural tendencies that humans have that make us bad at the markets. And there was a study done called The Behavior of Individual Investors. And it just lists a bunch of psychological aspects that traders have that make them bad at the markets. And so I'm going to get into understanding them now. And once you know what they are, then you can work on fixing them. If you never knew they existed, then it's hard to fix a problem that you didn't know was there. So I want to get into these problems. So this is actually known as behavioral finance. Um, it was coined by Professor Schiller at Yale, I think. He's big on behavioral finance and why markets act irrationally and how it's a lot less technical business and a lot more human emotion business that drives markets and trading. So humans have a desire for praise, and they at some point that praise goes away from somebody else telling you, oh, you did a great job, to inside knowing by yourself you have praiseworthiness. You don't need somebody to tell you it to you. You just need to know for yourself that you did a good job, right? But you only want praise for something you do well, right? You want to be happy and proud of yourself. Therefore, when you're trading, right, something that people get caught up in is, oh, I need to end the day green and only then will I be proud of my trading. That's the wrong mindset. You need to become the best loser when you trade. When you lose in a day, you should be like, okay, this loss was managed. I knew if things went south, it would be like this. No problem. On to the next, right? You want to look inside for yourself. So, prospect theory is how humans make decisions under uncertainty, right? Humans naturally, these are all natural tendencies of humans. And it states that people do not take small bets, right? Even when the outcome is in their favor, if it's a small bet, you'll be like, ah, it's fine. I'll move on to the next. But if the outcome's in your favor, even if you have to size small on a position, you should still do it, right? Psychologically, gains look much smaller than losses in our mind, right? $100 gain is not as much as $100 loss in my mind. No matter how much you tell yourself that, naturally humans are meant to believe they're loss protective, right? So gain losses just look huge to each other, and that leads humans to take big risks to escape these small losses, even though it's completely illogical once again, right? If you're taking big risks to escape small losses, it doesn't line up in terms of risk and reward. So you can see it in this chart right here. This is the prospect theory chart, and this value is basically like human value, how much it means to us, and this is loss and gain. And basically the theory states that this 5 cent loss only has this much value around 18 level, but a loss of 5 cents here, and you see this kink right here, is the reason it's like that and it's not a straight line is because that's how humans view gains and losses. So when you're a trader, you have to get over this idea that these losses are going to be, so you have to remember that it's all mathematical. A 5 cent gain is a 5 cent gain, and a 5 cent loss is a 5 cent loss, And once you start removing that emotion, then you can start trading a lot more tactically. So here's some more behaviors that we should know. There's something called wishful thinking bias, and that's when we hope for an outcome, and the outcome we want, we believe in our minds is higher than the actual probability of it happening. For example, if you're in calls, you're going to have a belief in your mind that the outcome for calls working out is much higher than the actual probability of it, when really the odds are 50-50, but in your mind, you're telling yourself, right? We also get this overconfidence in people, right? When a lot of it is luck, we see a lot of great people do amazing things, right? And you can't take that away from them. But you also have to remember how much of it is luck. I see a lot of people on social media, see a lot of traders do really well, and they build an overconfidence in them. They treat them like gods in a way, but really a lot of it is luck. And you see Elon Musk, Mark Zuckerberg, they're great, brilliant people, right? But you have to remember they got to where they were because of luck. So don't beat yourself up because something's not happening to you right now, right? Humans are naturally they're fooled by the randomness of the success of others. Everybody wants to believe there's a pattern to something when really there isn't a lot of the times, right? So another part of human psychology is something called cognitive dissonance. And it's this mental conflict after we learn that our beliefs are wrong. So once you're in a trade and it starts working against you, you begin to rationalize your own bad decision. You begin to tell yourself, hey, no, my trade is correct. Like I'm definitely right. The market is wrong, when that's completely not logical at all. But once we learn that our beliefs are wrong, something happens in our brain that tells us, okay, no, we're still right. But just intrinsically looking at raw data, we are the odds are stacking against us now, right? So when you're trading, you have to remember that you don't want to fool yourself. When you're wrong, you're definitely wrong, right? The odds are slowly switching. When the market is moving down and you're in calls, you're wrong. And especially with options trading, right? You can't just be right. You have to be right and you have to be on time, okay? Because otherwise data decay is going to completely tear up your trading, right? So you don't have enough time to be sitting there in an options trade while the market's going against you saying, oh, I'm down 50%, I'm down 60%. Don't worry, it'll come back up. And when it does, right, you get fooled and into thinking, I was right all along, when most of the time you're not right. There's something else called anchoring, and that relates lastly almost to this last point that I made. And it's humans naturally rely too heavily on the first piece of information that we have when making decisions, right? We use information that is irrelevant as we're anchored to that initial idea of why something happened. You see a pennant breakout and you see it break out to the upside. And then slowly the market starts turning against you, right? But we're anchored to the fact that, oh, no, it broke out of a pennant bullishly. It should work out. But slowly, when you take a look maybe on a higher time frame, the actual market has changed, right? But humans have this tendency to hold on to this initial idea. And that's why when a stock split is announced, especially in small caps, right? If let's say, I remember, I think a few years ago, Apple was trading at $400 and there was a stock split announced to 125, right? Everybody bought up Apple after the stock split, when there was no change in actual market value, right? There was more shares in the market, but there was no actual difference in how much the company was worth. But we're anchored to the initial idea that Apple was $400. Now it's 125. This got to be a discount, right? So we need to adapt as traders to new information. Otherwise, we'll end up buying things that are not justified, right? So a great example of this was the dot-com bubble. And this is obviously like a large macro thing that I'm talking about, the dot-com bubble. And basically what happened was, it even happened last year with the ARK names, the Kathy Wood names. Zoom was trading at $400. It goes down to 200. We're anchored to this initial idea that, oh, it was $200. I mean, it was $400. Now it's 200. That's a 50% discount, right? But if you look at the data, you see the economy is changing. The market is changing. Zoom's fundamentally was overvalued. If you looked at the PE ratio, how much money they were making, right? But a lot of people were attached to that initial idea that, oh, $400 was the initial price. Now it's at 200. And that's not how it works. Even today in the markets, right? SPX or the SPY could open up at $450. And yesterday it was at 447, right? So you may think, oh, it's gapped up $3, it's overvalued. But have you taken a look at why it's up at 450, at 451? There's no such thing as it being overvalued, right? The market is obviously pricing in something. Maybe there was news, maybe there was job numbers, right? It's pricing in something that's making it go up there. And you never want to place a trade saying it was this, now it's this, got to be a good trade, right? You never want to look at a stock saying, oh, AMC was $70, now it's 3. This is gonna be an amazing trade, right? That's not how it works, right? COVID hit, completely changed AMC. AMC was the meme stock, right? There's no correlation between these ideas. This ties into my next point, which is representative heuristics. This is when humans have this tendency to judge a situation based on something that's happened before. I'm sure you heard last year, when the market was going down, people were like, 2023 is going to be 2008 all over again. Really, there were very, very few similarities between 2008 and 2023. So just because something has happened before, it's highly unlikely that actually influences why it's happening now. So when you're trading, you want to look at everything with a clean slate. You don't want to say, oh, it's happened before like this, it's probably going to happen like this again, right? And when it's a little bit tricky because that's how technical analysis works, right? Like you see an ascending triangle and you say, these usually break out to the upside. But really, you have to remember, like, what if it doesn't break out to the upside? And this ties into my next third. The market is completely random. You cannot predict what happens next. Sure, you can make an educated guess, but the random walk theory basically states that each move that the market makes is completely independent of the previous one. And all the known information is priced in, right? So when you see one candle, you can try and guess what that next candle is going to do, but really you have no idea, okay? Once you accept the fact that really I do not know what the market is going to give me on this next candle, what I do know is that my risk is managed. What I do know is if the next candle goes against what I want, then I know how much money I'm going to lose. And it's basically like a lot of times small cap traders have experienced this big time, you know. I remember a year and a half ago, I was in CEI stock, right? And it was just technically looking so amazing, right? And I was in at $3.50, right? It was about to break out. I was in the stock pretty heavy, and I close my phone and I come back, and no matter how good it looked, some company released a short report on the stock in the middle of the day, and it fell 25% in the next candle, right? So no matter how much you think you know something can happen, yeah, Zach Morris, he was the one I see in the chat. Yeah. No matter how much you think you know something can happen, you have no idea. Therefore, the only way to make money in the stock market is by having this proper risk management strategy in conjunction with a trading strategy. So, you know, how do you trade? Do you use the tape? Do you use VWAP? Do you use EMAs, right? And then how much are you going to lose? That's the risk part of the strategy. You know, what are you going to do when you lose, right? So this is a great story from the Short Bear. If you don't know who the Short Bear is, he's this trader. He turned a few thousand into like a couple million over the past few years, shorting small cap stocks. He goes long now and trades many different type of stocks. But he had this story that he released one time, and I think it's a great story. And it's about losses and wins, right? So it basically says there's a lion can go and kill a mouse, right? But doing that much, trying to go and kill that mouse will take up so much energy from the lion that when he eats it, he won't be filled again, right? So you spend your entire day chasing these small mice, right? But you can't, the lion won't live in the long term off of mice. Maybe he'll live a few days, but he needs something big. He needs the antelope, right? Antelopes take a lot more patience, right? They have to wait. You have to wait for the antelope, and it takes some energy to actually get them, right? But after you get one, you build up, the lion builds up a lot of energy, and they can survive a few more days, right? So when you're trading, you have to ask yourself, are you spending all your time going after mice? Are you spending all your time going after these small wins, and then you don't have enough to actually hold you through bigger loss that you might take, right? In the long run, you're not gonna last, right? Now, not only would you get tired after eating the mouse, but you also miss the antelope. Sometimes you see the antelope go by and you're like, oh, I needed that and I wasn't there for it because I was too busy chasing these small wins, right? So the animal you are changes. You can be a mouse, but when you are a mouse, right, smaller count, you have to eat insects or you have to eat smaller things, right? You have to go for the smaller stalks, go for the smaller plays. Then as you grow into the lion, that's when you start going for the bigger ones. But you need to eat consistently. You need to eat safely and you need to eat something that's going to last you for a while, right? If you have a $10,000 account and you're making $20 a day and you're losing 200, right? That's not going to last you. But if you have, let's say, a $200 account and you're making $20 a day, right? And you lose less than that, then you'll be able to actually consistently be profitable in the market. So let's talk about risk strategies. And these are the actual strategies. And both of the strategies that I use everyday trading, I got from two books. They're called Best Loser Wins, which is the first quote from above. And the second one is called How to Day Trade for a Living by Andrew Aziz. And that these are basically the strategies I use. So adding to winners is one strategy that I use, right? Averaging down isn't worth the risk. Sure, when it goes back up, it feels great, but you have no confirmation that you're gonna ever be green again once it's going down. What I do is I add to my winners. So if you follow me on Instagram, whenever I post the trades that I take, you always see I usually buy something twice and sell it later. And the reason is because, for example, I buy it $100 and I buy it right before it breaks out, right? For $100. And I see it breaks out with momentum. Everything's looking good. Maybe there's options flow. Maybe there's something like that, right? Now it's at 110, right? And my price target is 120. Now that it's confirmed, it has momentum. I'll double my position at $110 and keep a stop loss at 100. My new average will be $105, correct? So I bought at 100, I bought at 110. My new average is $105, right? And that's my new stop loss. So now when it goes to 120, like my original plan says, then I'm actually double, right? And that's how I can chase these antelope. That's how I get those huge gains that carry my account. And when let's say it goes to 110 and it goes down on me, it goes to 105, I stop out for no loss at all. But when it goes to 120, I make a much bigger gain than I would if I just had the original position at 100. Now, you have to be very disciplined at selling when it goes back down to your stop loss. And you have to be, even if it goes down from 110 to like 105, you got to be like, all right, moving on to the next one, no problem. Remember, we're not marrying stocks. We are simply getting in, getting out. We are day traders. I do not care what happens to the stock later in the day. I'm going to make my money and then I'm going to leave, and if I miss it, I miss it. It's not a big deal, right? So you buy it 100, once again, you buy it an amount. Once it starts showing signs that it's going in your direction, you buy again and move your stop loss up. Now you have two scenarios. Either you lose. Oh, and I also want to mention when you buy at 100, right? And let's say my usual stop loss is 25, 30%. If I buy at 100, I'm losing 30%, right? But once it starts going in once it starts going in my favor, then I'm making double that from 105, right? So this is how we're getting these antelopes. And when we lose, we either lose nothing because my stop loss was at 105, or it never goes to 101, or it never goes to 110, and I end up losing the 30% that I would have lost originally. This next rule is called the 2% rule, and it's from How to Day Trade for a Living. And this is the rule that I think all of us should, I think everyone who wants consistency, you need to understand this rule. It doesn't have to be, it can be like the X% rule. It doesn't matter what the 2% is. Me, I like 2% because I'm very against risk. I don't like taking big losses. So you should never lose more than 2% of your portfolio in a day, right? You put 10% of your portfolio in any trade and keep a 20% stop loss, and that's 2%, right? Now, if the 10%, especially when we trade things like SPX, right? Those can go 100%, 200%. So then at that point, your entire portfolio is up 10%. But one thing traders should always remember is you need to live to see another day, right? You don't want to be the person that's blown up their account. Then what do you do tomorrow, right? This money's hard to come by. So for me, it's like 2% in a day. The moment I hit 2%, then it's like I gotta call it quits. But it also helps me be so much more non-emotional when I trade, right? When you think about it, I'm every day I know with the amount I'm gonna lose 2%, which for me is 600, $700, right? If I have a bad day, I'm gonna lose $600. And I know that going into the day, right? I know that going into the day, if I lose, I know exactly how much I'm gonna lose. And it's like, all right, I was prepared for it before going into the day. So a lot of people they do the 4% rule, right? I think once you start getting above 5%, then it gets a little bit, too much of the account lost in a day. And I know a lot of us trade with small accounts. I traded for a small account with a long time, and small accounts you do need to take more risk to grow. 2% on $1,000 just it's not it's not feasible, right? So maybe you want to make it a 10% rule, but even then you just have to be only taking high quality setups. The way I see it is you can use the average in strategy to a point where you have a lot of your portfolio in one stock and either you lose nothing or you make a lot, right? And you can only take high quality setups. But with a small account, you have to be very disciplined with stop losses. Honestly, any account, you have to be super disciplined with stop loss. Like the 2% rule, you have to be very disciplined of just, you're down, you're down. It's not a big deal. So with a small account, it's like you have to ask yourself, is this trade a low risk, high reward trade? Is this a trade where if it goes down, I can put in half my portfolio? For example, if I had $1,000 account, I can put in $500 and um, if it goes down 20%, then my entire portfolio is down 10%, but it has a very high probability of going up 100%, and therefore my account would be up 50%, Is that feasible for this trade? And you have to be very honest with yourself. And if it's just a scalp, then it's like maybe it's not feasible, right? But if it's a like a day trade where the setup is there, lots of confluence, you see options, everything is working, right? Is that a trade you want to take? So I seen the chat, small account, full port, high probability. Um, Full port is always like I mentioned earlier, you don't know what's gonna happen next. So full porting is I'm always against that, right? I mean, if your stop loss is like 5% on the trade, sure, you can full port, right? But like you have to also remember that trading these low risk, high probability setups are hard to come across, right? So this next one, I'm gonna talk about risk and reward. And you can have any percent of a almost any percent of a win rate, but it's your ratio that's gonna matter, right? So for me, when I trade, so over I think last year I had 5 months worth of data, and when I was trading small caps, I had an 81% hit rate over those 4 or 5 months, right? Which puts me right here, which means I just need to be above like 0.7, right? For every dollar I risk, I just need to make 70 cents in order to win, right? At this 80%. Now, when I trade SPX, I'm closer to this 65% range because I'm not as good as trading SPX. I'm much more comfortable with small caps. So therefore, my SPX trades are usually in this range, right? I have a 30% stop loss, which means I'm looking to make at least usually 50%, which is not difficult when trading zero day to expiration options. Obviously, they're more risky, and your win rate goes down, but that's why my win rate's over here, but your profitability rate is higher. So you need to ask yourself, you need to say, okay, if um with a base level of technical knowledge, you can have, like I mentioned earlier, with a few months, you're at a 60% hit rate, and you need to ask yourself, um, am I in the profitability zone, right? You need to be honest with yourself, and in the profitability zone, and to increase your win rate. Okay, this is where technical analysis starts coming in. I know I said earlier that technical analysis isn't the reason why traders fail, but if you want to increase this number right here on this percentage, you need to have something more than just support resistance. For me, it's options flow, right? That helps me get an edge, and Fibonacci levels when I'm trading SPX. And when I'm trading small caps, it is short squeezes and just having a good understanding of them. So that gets me to this 80% zone. That gives me that boost, right? And when I'm trading SPX, that takes me from like here to here. And with Hassan, I know he's just an amazing trader. So his win rate is probably much higher because he's really great at reading the tape and understanding that price action. Me, I'm not the best at that, and I'm honest with myself about it. So I size smaller into SPX versus if I was in a small cap, right? So today we basically talked about trading with a plan, right? You want to go through these psychological aspects of humans, which is um understanding that gains as humans naturally are going to look smaller than losses, but mathematically they're the exact same. And we never want to take big risks to escape small losses. If you're down $20 in the day, there's no reason you should risk $200 just to make that $20. It's completely illogical. But then again, humans are illogical. And you can see it based on this prospect theory chart, which I explained earlier, right? A 5 cent gain has a value of 17 to us, but a 5 cent loss has a value of 40 to us, right? And you want to remember this and be like, okay, losses and gains are the exact same. And when you use this, right, losses and gains are the exact same. Okay. When your losses are smaller than your gains, you move up here. And once you get better at technical analysis, there's a large zone for profitability, right? So it's not hard to be profitable, but people's losses just end up eating them out. And that goes here. How much are you going to lose today? Do you know before you get into the market that I'm going to take one trade today and I'm going to lose 1%, and then I'm going to take another one. And if I lose 1% on that, then I'm at my 2% rule and I'm not going to trade anymore. Do you know how much you're going to lose today? Do you go into your day thinking, let's see what the market gives me? Because you can't trade like that. You'll never be consistent like that. Consistency is knowing what's going to happen. I can tell you tomorrow. I can tell you right now that tomorrow I'm either going to make I'm gonna make money or I'm gonna lose 2%, right? And once you start trading options like ODTE, right? Today I was up, what, 12%, right? With 2% risk. Okay, so that's 1 to 6. That's that's off this chart. It's way in the profitability zone, right? Because especially when you trade things, options can move in your favor very fast, right? And when you don't let them move against you by keeping that 30% stop loss, by telling yourself that I will sell once I hit my max loss for the day, then you live to see another day. I can go 3 days in a row taking 2% losses and my account will be down 5.8%, right? 2% and then 2% of the next day and then 2% of that, which will obviously be smaller. That's close to 5.88%, I think. Right? So you can still not lose a lot of your account. And then when you have a great day, right, by averaging in, right? I was in S&P SPX puts today. I bought them at 250. They went up to 340. I bought them again at 340. I think my average was um close to like 2.7. So I moved my stop loss to 2.9. So I was gonna make money either way. And then the market just dumped on me and I was doubled up in the position and I made a huge amount, right? Almost 12% of my account. When my max loss was 2%, right? It's you just have to be honest with yourself about when you're gonna sell, right? You have to remember you can't predict what happens next. All you know is where you're gonna start, where you're gonna sell, and where you're gonna buy, right? Um, Make sure you adapt to the market, right? What has happened in the past doesn't mean it's gonna happen again. And if the market is turning against you, make sure you're able to continuously look at it with a clean slate. You're able to tell yourself, hey, price action isn't the same. And I need to go over that, right? And yeah, I will be going over my trade. Um, the next thing is how much did I make? I made around 5K on the trade today. So on SPX, yeah. Um, the the line in the mouse analogy basically is telling you don't go chasing these mice, right? Don't waste your energy on these 10%, 5% trades, right? Save your capital. Wait. I waited the whole day until the last hour of the day. I was sitting there staring at the market, just like, nothing much to do, right? So yeah, everyone that's printed in 2021 is gone, right? Everyone that made so much money, they lost it because either they bet again, but they didn't know. I mentioned earlier, they didn't know what the market was going to do. Just because the market like died today doesn't mean that it's going to continue like that tomorrow. I have no idea what it's going to do tomorrow. I mean, I can make an educated guess and have a swing trade in for it, but I have no idea what's going to happen tomorrow, right? Nobody has any idea. The people sitting on Wall Street don't have an idea, right? And actually, speaking of Wall Street, this 2% rule, this hedge fund manager that I knew, he sold his hedge fund and he trades his own capital, and both his hedge fund and him never risked more than 2% of their capital in any trade, right? No, a position, they could be super confident in a position, they never risk more than 2%, right? Because this is how you maintain consistency. So even if your account is 500, I mentioned this a little bit earlier. I said small accounts, you got to take a little bit more risk to grow, right? 2% of 500 is like, it is not enough. It's not enough risk. And when you're trading a small account, you just have to be very diligent about where your stop losses are. And, you can put in half your account. You can put in $250 in a trade, or you can put in $250 in a trade and keep a 20% stop loss on that. And that's $50. And when it goes against you, you lose $50, right? But if it goes with you, right, you only want to take high quality setups. You don't want to take anything where with a small account, you never want to take anything that's under two, right? If I'm gonna lose $50, I want to make at least 100, right? So sorry, I want to make at least a win profitability ratio of 2, right? Because when you're trading a small account, you do have to get lucky. I mentioned that earlier. You see these people on Twitter, where it's like, where is that? Uh, we're fooled by the randomness of the success of others. We see people turn $100 to like 1,000, right? And we're fooled by, but it's just random. It's random success, especially with small accounts. It's like I grew mine by getting an AMC early, right? I will admit it right now. When I grew my small account for the first time, I got lucky, right? And from there, once you get lucky, then you can start actually making these decisions. But when it's hard with $500, you can only take a certain amount of trades with a certain amount of money to grow it, right? And when you are trading those trades, you want to take the antelopes, right? AMC was my antelope, right? I risked what $250. I ended up making like 3,000, right? And it's you don't get trades like those every day, but when you do, they grow the account, and that's when you start managing your risk like this. This is meant for people who are trying to trade like every day for a living. And to be honest, $500 is not enough to do that. But once you have enough, this is when you want to start using this rule and going into the day. Even the rule applies for a small account too. Even if you have $500, you should be going into your day knowing, okay, I'm gonna lose $50 today at the worst. Um, and you should be able to tell yourself that. You shouldn't be having a $500 account and you end the day at 250 and you're like, what happened? No, you should be able to tell yourself, this is how much I'm gonna lose. Um, like I mentioned, you want to know how much will I lose today? How much will I make, right? Because if you're losing 2%, but you're making 1% and you're not at a certain amount, like, you want to also know where your price targets are, right? You have to remember all probabilities are even. What happened, what's going to happen next is the exact same probabilities. The next candle has a 50% chance of going up, 50% chance of going down. Same with the one after that, same with the one after that. No matter how much you think you're in control, you're not, okay? You also have to remember the market is open every single day of this work week, okay? And it's going to be open every day for until the end of your life, okay? Having a small red day, being down, um, being down $100, $200, right? Being down that much is not, or sorry, 1%, 2%, being down on a $10,000 account, being down 1%, 2%, it's not worth getting into another trade. Let me put another $1,000. Let me get out of this hole. If you've hit your loss, just close the computer, come back tomorrow. It's going to be open again. It's not worth taking a red day to, like, it's better to take a red day than just take unnecessary risk to be green. And this part of prospect theory, humans were naturally wired to take these big risks to escape losses, even though it's completely illogical. We're wired as humans, okay? And what we have to do is we have to rewire ourselves. I mean, we're all humans, right? Yeah, engineers, teachers, computer programmers, everyone's humans. The difference with traders is you need to be so in tune with these emotions. You need to understand that we want to, as humans, take big risks and to get out of those small losses. That's illogical. We don't do that. As humans, we believe that losses are bigger than gains. That's illogical. We need to get over that. Wishful thinking. We believe that the outcome we want is actually a higher probability than what we're gonna get or what it really is intrinsically in real life, right? We need to get over that. Okay. We need to get over once we learn our belief is wrong, we begin to fool ourselves that we're still right. But once again, intrinsically, the value of the data that is showing us is wrong. We can't rationalize our own decisions and do the illogical thing. We need to tell ourselves, hey, I'm wrong. Let me change my mindset. Now, if you have a trade plan, you don't want to just change your trade plan in the middle. But if it hits your stop loss, you're wrong. Don't tell yourself, it's going to come back up. It's not going to come back up. And even if it does, you're just getting lucky. That's not a strategy. You're not going to last in the wrong run, right? So this is basically, you want to add to your losers and move, I mean, sorry, add to your winners and move your stop losses up because once it has momentum, you're doubled in and you either lose nothing or you make a lot. And when you lose half the size, right? 2%. I've told you how important this rule is to all accounts that are trying to trade for a living. Small accounts, like I mentioned, you got to take more risk. But if you start incorporating this, you'll be able to at some point have a lot of your account in a trade and know as long as you have the discipline to sell once it goes back to your new stop loss to lose nothing, then you're okay. So I've shown the risk reward chart, and that's basically everything I have on trading psychology. Of course, you can get these slides. I'll put them up in my channel. Now, a lot of y'all wanted me to go over my trade from today, so I'm gonna go ahead and do that. Then I'm gonna show you all the strategy I've used. I've taught it before, but it was like a year ago, so I'll teach it again. And then I will also go over some of the tools I use to find small caps because I know everyone loves those. So let me stop this sharing and let's go to TradingView. All right, so I hope everyone is able to see my TradingView screen. As you can see, I trade with Fibonacci levels during the day, and this is what I do. So what I do is called opening range breakout, right? So opening range breakout is Fibonacci levels of the first 5 minute candles of the trading day. Right, that's what I'm doing. So I take the Fibonacci tool on TradingView and I look for 1, 2, 3, 4, 5. Right now that I've confirmed that this is the opening range breakout, right? We have all these levels, right? And you see how well do you see how well the market it respects those levels, right? It bounced there, goes down. We're holding, you have to remember, okay, the 618 and the 0.5 levels are the most important levels in the market, right? So I'm going down and I'm just seeing what's gonna happen. So in the morning, I saw we bounced here and we couldn't reclaim. So I knew the market was weak. Then then it's just basic technical analysis. This is the trend. We break the trend. We hold. We bounce. This is 0.618. Do you see how important this level is right here? Right in the morning, it trapped some people right here. It bounced and trapped, right? And then we had this nice build up and um build up, build up, build up. We break the trend, right? And then it's just here. So now I know I'm waiting the whole day because all this chop is like I didn't see a viable trade in the chop, right? Like I didn't see anything here that I was like, okay, I want to actually get in to a position. Maybe if we broke out above this level, that would have been bullish to the upside, but we didn't. We broke down and then just once we got here, I was watching. I wanted to see, are we going to double bottom, right? This was huge. This 0.618 level was huge, huge. So we come back to this level 1, 2, 3, 4 times. Now, I know that tomorrow is FOMC, right? I know that tomorrow is the FOMC day. So let me actually go back to the previous Fibonacci levels I had, right? Sorry. I do not know why it's going letter by letter, but I want to show you how I use the previous Fibonacci levels. Okay, so I I during the day, I after I saw that bounce, I came up and I changed the Fibonacci levels to what was that no 0.618 low. I changed it to the low. So these are my levels. These are the levels I'm going to use for the rest of the day. And if you saw in the Discord I posted, I wanted a short at 445.38. And as you can see, we just barely missed that, right? Just by what 4 cents. So my alert never fired off. And if my alert doesn't fire off, then I'm not in the trade. But if you saw in the morning, I marked this level as that 0.618 level. And I was like, sorry. And I marked this level as that 0.618 level. So this is my big level for the day. And that's all I'm watching. All I'm watching is into the end of the day. Either we break above this, okay? Or we break above this, just basic support and resistance, right? There's nothing special about this. Honestly, you don't even need the Fibonacci levels. That just gives me added confidence, right? That just gives me an added sense of, okay, there's some confidence here. Now, at the end of the day, I knew FOMC was going to be playing out tomorrow, right? So I knew that we're going to probably likely get a move before as traders are positioning for FOMC. Um, so I see we test this level 1 time, 2 times, 3 times, 4 times. On the 5th time, I was telling myself there's no the more you test the level, the weaker it gets, right? The more orders are getting filled. So I'm like, all right. So on this candle right here, right, just before 2:30, I I add let me show you. I add some puts. I see it goes up there and it rejects this. So I've added puts now, and my stop loss is right here. Okay. My stop loss is right here. Okay. I've added puts, stop loss right there. What am I risking? Like 15 cents an ODT on contract is around 30%, right? So my risk was there. If it broke above that level, I'm out. I'm not gonna force it. Then we break under here. So now I'm in puts. Then once I see we break under this next level with momentum, you see how much momentum I add onto my puts. So now I'm doubled in my puts and my average is closer to here. So if it goes back above, right, and then I'm just gonna sell for nothing. But what happened was the market completely dumped. And as it went to this level right here, I got out. Right. Obviously it went down a little bit more, but once it went down here, I had huge positioning, right? Because either I get out for break even, huge positioning, boom, get out right there, winning trade. And all I did, it was so simple, so simple. Look at this. You take out everything on the chart. I waited for it to break, right? Or sorry, I waited right before I thought it was gonna break because it's testing for the 5th time, right? 5th time into the end of the day before FOMC, right? Breaks through. I add more right here. My stop loss is now closer to here. Completely goes down. ODTE moves 200%. I'm out, right? So I hope uh I hope that helps a little bit with my trade today for everyone that was asking. Next, these are the few tools that I use. Obviously TraderLink. We are working very hard to make the unusual activity section options really good. For unusual options, I'm always looking for stocks where the volume is greater than the open interest and on the contract and it's out of the money. As you can see above ask, this is just great to look at during the day if you don't want to trade the S&P 500. Really what I do is I'm watching the SPY tape and I want to see some big orders come in. This is my favorite feature, the SPX speed feature. This is the contract which I choose. So if I'm going for calls, I'll use the 44.55 call. And if I'm going for puts, I would honestly, these are pretty much the same. So I'd probably go for the 44.10, right? Because those are ones that's going to move the fastest. So do you wait for the candle close to get out or when it wicks? So usually I wait for the candle close on the 3-minute chart, but if it's OTTE and like the end of the day, the moment the price touches that level, I have no patience because candle close can mean, but if I'm playing 1 day to expiration or it's like a longer day trade, I'll wait for candle close. For my small caps trader, this is called biofarmcatalyst.com. This is where I see all the catalysts for stocks. As you can see, just has the different days. And if I see a catalyst coming up, I make sure to keep my eye on a stock. But this is for small caps, really, biotech traders. If you don't trade biotechs, this is of no use to you. The next one I use is called thefly.com. It's free, and I use the street. Sorry. How do I get here? Yeah, so I use these for news, and in the morning they have a great section on um um, the morning section, and I always look for Wall Street calls. I love when stocks upgrade a stock because it brings or downgrade, it brings volume to that stock, especially the small cap ones. So I'm always looking for that, always reading the guidance, and I'm always looking for movers. So these are how I find my smaller names that I trade in the morning. All right, they are kind of under the radar, website. Something I want to look for every morning. Um, of course, TradingView.com I use, and that FinViz is a great tool, insider trades, stuff like that. Of course, I'm a big fan of Flow Algo. I'm always looking at the options flow when I trade. And yeah, I don't think there's any other tools that I use on a daily basis. A hidden tool is called Stocksera. Um, Actually, I do my charting on stockcharts.com. I just use trading view during the day. But stock trade just I get a more cleaner look at the. It just helps me trade. It's um nothing important. But you trade full time, right? Well, yeah, I'm actually still in school, so trading full time. I'm a full time student, and but I do trade. Like this is basically how I make my money trading. Yeah, I'm 18 years old. Yeah. Um, Actually, I'm moving to a new city this weekend. Should be interesting. That's besides the point. This website is great. You get stocks with a high cost to borrow. You can discover short interest, high short interest. I love the low float. This is my favorite site. So the float is basically how many shares are available to trade, and when there's less floats, when the float of a stock is small, that's how you find stocks that it'll take a little bit of volume to move it a lot, right? So I'm always looking for low float stocks with high short interest. As you can see, Bullfrog BFRG right now is pretty big one. Finviz is basically what I use for news in the morning. I love reading the news. I love catalyst trading. Um, where I'm in Houston right now. So yeah, I'm that's basically all the tools that I use. I hope you understood the psychology part. I'm big on catalyst trading. I love when stocks get upgrades or downgrades in the morning. I post them all in my channel usually. Catalyst can be anything. It's a catalyst is like high short interest. Catalyst can be um insider trading. Catalyst can be the upcoming FDA events. Catalyst can mean anything. It's how you trade it, right? So did you lose money in the starts? Um, yeah, of course, I lost money in the start. Like I lost for a year and a half, before I actually discovered, before I got lucky with AMC, and then I discovered strategy, and then I lost money after that, and then I really started getting into a strategy, saying I'm only going to lose 2%. I'm going to size heavier after I start winning more. Everybody loses in the starts, right? Don't be afraid of losing. Be afraid of losing a lot, right? And even listen, even if you do, lose a lot. Like we're all human. Don't beat yourself up. Like you tried your best. You're obviously trying your best. You're not here to lose money. Don't beat yourself up. Go to sleep. Wake up the next day. Tell yourself you won't do it again, and follow through on that, right? Like I mentioned in the PowerPoint, humans have a desire to be proud of themselves, and you can make that happen for yourself. You can, and the only way you can do that is by telling yourself you have a consistent plan where mathematically it works out. And if you've seen the Oppenheimer movie, theory can only take you so far. You got to put it into motion, right? Everybody loses in the start. It's okay to lose. It's okay to learn. Try to focus on how you're going to cut those losses, how you're going to add to your winners. How much are you going to lose? Do you know that already? And I keep saying the same things over and over, but that's because there are very few concepts in trading that are new, right? The base concept of trading is the same. Um, what time frames? Yeah, I'm usually on the 3 minute chart. Well, for entries or for ODTE, I'm watching usually the 1 minute chart because I want to time my entry as close to perfect as possible. Otherwise, I just get eaten up. But if it's not ODTE options, if it's weekly, like the same week or something like that next week, then I'm using 5 minute, 3 minute chart. How long have you been trading? Trading, I've been I started trading shares 4 years ago and options like 2.5 years ago. Yeah, as long as you lose and learn from it, it's market tuition. Agree, it's market tuition. Um, you just have to, I listed all the behaviors that humans have. The best way to stop paying tuition is to tell yourself, I'm not going to give into these behaviors. I know what my plan is. I know how much I'm going to lose. I'm going to write it down and I'm going to follow it to a T. Because as long as it works out theoretically, it'll work out. What's my strategy called? My my strategy. I don't know. The young goat whisperer. Yeah. Did you become profitable in options? No, options took me just so long to actually figure out. Shares are easier because it's like, there's liquidity. There's options are like you have theta decay working against you. You have IV working against you. You have all the Greeks working against you. Um, you have like if you don't time it right. So no, I wasn't profitable with options in the beginning. It took me so long, but there's a reason so many millionaires are made off of options trading and trading like that. It's because they're they're so volatile that you can take advantage of it. And as long as your risk is managed, you can manage that volatility as well. How'd you find Rippy? I was in TCX Trader Circle asks. I remember that. And I would just join the voice call and I edited some videos for him. Yeah. Here, I think Rippy is one of the best traders of all time. you just watch him trade, and it's like, it's very inspiring when you see how he manages risk. And that's something that I've always wanted to take in for myself. He always knows, like, when you watch him trade, he's very disciplined about when he's going to cut, the level he's going to cut, when he's going to take off from trading. That's something to aspire to be too. And every day, like, I try to get closer to that. Tips for knowing when to cut a winner before it becomes a loser. So yeah, I mentioned a little bit earlier. Um, Once my winner, especially in options, once I'm up 15, 20%, um, my stop loss is at break even. You know, I don't think there's a reason for me to hold it down below zero again when I can just probably enter again later. Um, I mentioned you can average into a contract and then set that average at your break even. Set your break even at that average price. Um, so you never want to let a winner become a loser, especially after like 10%. Okay, like that's just the volatility of the market. 15%, that's when you start getting to like, okay, there's really something here. After 15%, maybe you want to average in. 20%, you want to average and move your stop loss up and ride the momentum. Do you guys go on voice? Yes, there's voice on the Discord daily. Um, Trading on voice is a great part of learning. You get to see in real time how he's trading. It's amazing. Who's my mentor? Hassan is my mentor. Was my mentor. Is my mentor. Um, He's just an amazing trader. So your plan, yeah, my plan is from the day before, but not really. I don't know. Like I mentioned, I don't know what the market is going to give me. What I do have are my levels, where if it breaks above this, I'll enter. If it breaks below this, I'll get into puts. But my plan is in. I know exactly how much I'm going to lose tomorrow. So my plan tomorrow is make money or lose 2%. That's the plan, right? Now, the technical aspect, I'm reacting to the market. I don't know what the next candle is going to give me, but I'm going to react to it, right? If I'm going to react to it's broken out of this channel, I'm leaning bearish. I'm going to enter puts, but if it goes against me, I'm going to stop out to where my max loss is. What are some things you would tell your beginner self to do and avoid? Um, there's some things I would tell my beginner self. That's a great question. Um, don't average down. I think most of my losses have come from me averaging down. um, Avoid falling prey to the social media hype behind a lot of traders. You have your plan, follow your plan. If somebody else made $1 million in a day, it should matter zero niche to you. It should not mean anything, right? Avoid zero data expiration options at first. Avoid honestly, like get a feel for how the market works, right? Get a feel for how price plays out. How does like with small caps, at 11 p.m. I've noticed they start to bottom, but you only notice that after you trade them for 6 months, right? 6 months. SPX, the day before a big meeting, there's usually a last big end of day move. You only notice that after you trade for a while, right? So understand how the price works. How does the market work? He's the best trader I've ever seen. Yeah, I've never seen anyone. I saw him do that live. It's amazing. When did you figure out, or what did you change to become consistent? It really was just telling myself the day before that when I lose, I'm only going to lose this much. That's consistency, because technically, like my technical skills are good enough where I'm making 70%, 80% hit rate, right? Um, so that's what I changed. If I'm making 80%, but hit rate, but like my losses are gonna be like 50%, 60%. There's no point in me making 80%, right? So figuring out that I could only lose so much in a day before I had to just get out is what made me consider. Are you going to college? Yes, I am going to college. I'm doing finance, obviously, in college. And some just interesting courses. Like I think I'm doing one on black holes next semester. Just stuff that I wanted to do kind of. So yeah, I am going to college. Yeah. And you're a loser. Which tickers? So I either trade small caps or SPX. Small caps because I've always felt like I had an edge there finding short squeezes. SPX because very liquid, zero data expiration options, tax benefits. I didn't feel like in large cap land, I'm so trash at trading like Tesla, Nvidia, all that, just because I don't understand how that price action works. But with small caps, I understand how to read the tape on small caps. I know how short interest, social media hype, I know how all of that plays into how a small company moves. I know how they like to raise money once they go up a lot. I know how shorts like to trap people. I'm great at reading it, right? So Tax benefits to trading SPX is that instead of taxing everything as short-term gains, I'm not a tax advisor. I just legally have to say that. I no idea anything about taxes, but um, honestly, I'm gonna let the computer talk. That way I don't get in trouble. Tax benefits. It's 60%, I believe, gets taxed on long term, and 40% of your profits gets taxed on short term. But so I just want to say, so yeah. So they're taxed at a lower rate, right? So yeah, 60% are taxed at long-term rates, while 40% are taxed at short-term rate, right? It doesn't matter if you held it long-term or short-term, right? And you just pay less. So that's why I like taxes. Just I wanted to confirm that so I didn't give anyone wrong information. Yeah, if there's are there any more questions? That I basically told you all about psychology. I'll post the PowerPoint slides. I told you all my strategies, how I choose, what I trade. Can't think of anything else. Have you tried futures? Yeah, I did try futures. Let's see. I didn't like it a lot. What I loved about options was once you have momentum, it really starts rolling in your favor. You know, you get the benefit of gamma, you get the benefit of IV boost. Like when the market dropped today, and I got in those puts, the reason they went up so fast is because of theta decay. It worked in my favor because of gamma, right? It worked all in my favor. Um, so I like features, but I'm not once again, you just need to find where you're comfortable with. And I wasn't comfortable with features, and maybe it just takes some time to learn. But at this stage in my trading career, I don't feel like learning a completely new derivative. Are you planning on dropping? No, no, I'm not planning on dropping out. I'm excited to go learn at college. I think college education is very important. And finance, you know, I always wanted to work on Wall Street, and I think you kind of need a degree to do that. Not that, I think it's important for everyone to get a college education. So no, not dropping out. Not that there's anything wrong with not going to college. You know, everybody has their thing. My thing just I like theory a lot and learning. Um, no problem. Thank you all for coming. It means a lot that you would spend an hour of your day coming to my presentation.